Urgent for you, seniors. Starting 2026, the risk is imposing US dollars is a 0.000 bank limit that could directly affect your lay, and dati pension payments. And you need to know how this may impact your finances before it's too late. In this video, I'm breaking down exactly what this new rule means, what actions you must take, and how to protect your pension income from unexpected complications. If you're over anamnapu or rely on Social Security, this is information you can't afford to miss. Stay with me until the end because I'll reveal crucial tips that could save your benefits. And make sure you hit that subscribe button now so you never miss updates like this. This channel is dedicated entirely to seniors in the United States, keeping you informed and prepared every step of the way. There is a rule sitting quietly inside the American banking system that most people have never heard of, and right now, in 2026, it is more relevant than ever, especially if you are senior, a retiree, or someone who has spent a lifetime carefully saving your money. This rule doesn't announce itself. It doesn't send you a letter. Your bank doesn't call you to warn you about it. It simply activates the moment certain threshold is crossed, and once it does, information about your financial activity travels directly to the federal government. The number at the center of all of this is US dollars is a 0.000. Not a million. Not 100,000. Just $10,000, an amount that, for many retirees, represents a Social Security lump sum, a small inheritance, the sale of a car, a home repair fund that's been sitting in jar for years, or simply money that was moved from one account to another. And if you don't understand how this rule works, you could find yourself in a situation you never saw coming for no reason other than not knowing the rules of the road. Let's start at the beginning, because to understand why this rule exists today, you have to go back more than 50 years. In 1970, the United States Congress passed a piece of legislation called the Bank Secrecy Act. At the time, the country was dealing with a serious and growing problem. Criminals were using cash to launder money, fund illegal operations, and move enormous sums of untraceable currency through the financial system. The threshold was created as part of the Bank Secrecy Act, passed via Congress in 1970 and later adjusted with the Patriot Act in 2002 as an effort to curb money laundering and other illegal activities. News & World Report the law required banks to act as a kind of first line of defense, flagging large cash transactions so that federal authorities could trace the flow of physical currency and investigate suspicious activity. The number they landed on, US dollars is a 0.000, was significant at the time. Back in 1970, it was worth about US dollars 80,000 in 2025 dollars. The motley fool Congress never updated the threshold. So what was once a rule designed to catch high-rolling criminals now catches everyday Americans, including seniors depositing retirement savings, receiving an insurance payout, or simply managing the kind of money that an honest, hardworking life produces over time. Here is exactly what happens when you cross that line. Under the Bank Secrecy Act, banks are legally required to report any cash transaction exceeding US dollars is a 0.000 to the federal government. This is a standardized process to help the Financial Crimes Enforcement Network, known as FinCEN, track the flow of physical currency. Any transaction you make exceeding US dollars is a 0.000 requires your bank or credit union to report it to the government within 15 days of receiving it, not because they're necessarily wary of you, but because large amounts of money changing hands could indicate possible illegal activity. My bank tracker, the report that gets filed is called a Currency Transaction Report, or LIDR, and here is the thing that surprises most people. This report is filed automatically via your bank, and you won't receive a copy or even a notification that it was submitted. The motley fool: you walk in, you make your deposit, you get your receipt, you walk out, and somewhere in the background, a form with your name, your account number, and the details of your transaction has been sent to federal authorities. You will never know it happened unless something comes of it. Now, before the alarm bells start ringing too loudly, let's be clear about something important. Filing a currency transaction report is not the same as being investigated. It is not an accusation. It is not an audit trigger via itself. The vast majority of these reports are never looked at twice. If your withdrawal is linked to legitimate activities, you have nothing to worry about. The ACIR is a routine filing that is rarely scrutinized unless there is a pre-existing investigation. The motley fool: most people who deposit or withdraw more than $, is a 0.000 in cash are doing exactly what they appear to be doing, managing their money honestly. The problem isn't the rule itself. The problem is what happens when people don't understand it and try to work around it, because the moment you do that, you move from being an innocent person making a large transaction into someone who has potentially committed federal crime. That crime has a name, and it's called structuring. The most common way people get into trouble involves trying to avoid the report rather than making the deposit itself. If you have $12,000 and decide to make 3 separate deposits of $4,000 to stay under the radar, you are committing federal crime called structuring. Yeah, this is the part that catches so many seniors completely off guard. The reasoning seems innocent enough. Maybe someone has heard vague stories about the government monitoring large deposits. Maybe they just feel uneasy about the idea of our report being filed. Or maybe they simply think breaking it up makes the whole thing less complicated. But the law doesn't care about your intention. Banks may assume, rightfully or wrongfully, that you're breaking down and structuring your deposits this way. You're deliberately trying to circumvent the Bank Secrecy Act and the bank's CA process. Structuring itself is illegal. It tells the government that you're trying to get around and evade their reporting laws. My bank tracker: the consequences can be severe. Federal authorities can freeze your accounts. They can seize your funds. They can open criminal investigation. According to the IRS, in 2016 na, $43 million was seized from 600 depositors under suspicion of structuring. My bank tracker: many of those people were not criminals. They were just ordinary Americans who thought they were being careful. And the net is cast even wider than most people realize. If an individual makes cash deposits over several days that are less than but still add up to at least $, is a 0.000, that person will be reported. This applies even if you spread your deposits across more than one bank. Liea, News & World Report: so if you took $500,000 to one branch on Monday and $3,000 to a different bank on Wednesday, and the pattern looks deliberate, you can still find yourself in the crosshairs. The banks are trained to look for exactly this kind of behavior. Suspicious activity in excess of $5,000 detected via the bank or an institution is also required to be reported. Liea, News & World Report: that means even transactions that never reach the $, is a 0.000 mark can trigger suspicious activity report if a bank teller or compliance officer thinks something looks off. For seniors who are unaware of these rules, simply trying to be cautious with large amounts of cash can inadvertently look like exactly the kind of behavior the law was designed to detect. There is also a common misconception worth addressing directly because it comes up constantly in online discussions and has caused real confusion among retirees. Personal checks and wire transfers over $, is a 0.000 generally do not trigger currency transaction report because they already have digital paper trail. The $, is a 0.000 rule is specifically targeted at physical currency. Yeah, this is a critical distinction. If you sell your car for $15,000 and the buyer pays you a check, or if you receive wire transfer from your investment account, you are not walking into the same reporting situation as if someone handed you $15,000 in bills. Digital transactions carry their own records automatically. Physical cash, by its very nature, is harder to trace, which is exactly why Congress drew the line where it did. For seniors who still operate heavily in cash, and there are many, this distinction matters enormously. Now let's talk about the broader landscape of 2026, because this is not just about the US dollars is a 0.000 cash reporting rule in isolation. This year has brought a significant wave of changes to how the area and the federal government interact with everyday Americans, finances, and seniors are right at the center of it. The One Big Beautiful Bill, signed into law on July 4, 2025, has reshaped the tax picture in ways that are genuinely important for retirees to understand. For tax years 2025 through 2028, taxpayers who are age 65 or older may be eligible to claim an additional $6,000 deduction per person, or $12,000 if married filing jointly and both spouses are eligible. Internal Revenue Service. This is a brand new deduction, stacked on top of the existing additional standard deduction that seniors already receive, and it represents one of the most significant pieces of senior-specific tax relief in recent memory. But like everything in the tax code, there are conditions. To be eligible, the person must be 65 on or before the last day of the tax year, and the deduction phases out for taxpayers with modified adjusted gross income over $75,000 or $150,000 for joint filers. Internal Revenue Service. For every dollar you earn over those limits, the deduction is reduced by 6 cents. The deduction disappears entirely once your modified adjusted gross income hits $175,000 for single filers, or $250,000 for joint filers. Saving advice. And there's another important wrinkle for married couples. The One Big Beautiful Bill Act has established strict joint file only mandate for this new senior bonus. If you choose married filing separately, you are automatically disqualified from the deduction entirely. Saving advice. For seniors who have historically filed separately for strategic reasons, to manage income-driven repayment plans, or to isolate themselves from a spouse's financial liabilities. This creates very real trade-off that deserves conversation with a tax professional before the April deadline. On the banking and reporting side of the picture, 2026 has also brought some relief for seniors who were worried about the expansion of IRS monitoring into everyday digital payments. You may have heard the panic around the so-called $6 rule, a provision from the 2021 American Rescue Plan that would have required payment apps like Venmo, PayPal, and Cash App to report any user receiving more than $6 in transactions directly to the IRS. That rule caused enormous anxiety among seniors who used these apps to receive rent payments, sell household items, or split bills with family members. After years of delays and public outcry, the One Big Beautiful Bill has raised that limit. For the 2026 tax year, the threshold for a Form 1,000 has reverted to the old standard, $20,000 in payments and 200 transactions. This means that unless you are a high-volume power seller, your casual personal transfers are once again invisible to the 1,000 reporting system. Saving advice. Additionally, starting January 1, 2026, the threshold for Form 1,000 NEC and Form 1,000 MIS has increased from $600 to $2,000, a significant win for seniors with small side businesses. Saving advice, come if you do any kind of consulting, freelance work, tutoring, crafting, or any other independent income-generating activity in retirement. You no longer have to navigate a 1,000 at siyam na putsyam form for every small payment you receive. The paperwork burden that was steadily creeping into the lives of retired Americans has been pushed back, at least for now. However, there is one new rule that specifically affects seniors who send money abroad, and it has flown largely under the radar. Under Section 4,475 of the One Big Beautiful Bill, new 1% federal excise tax now applies to international money transfers where the sender uses cash, a money order, or cashier's check. If you go to a retail storefront to wire US dollars 1,000 in cash to relative outside the LUA, the provider is required to collect US dollars 0 tax. However, digital transfers from your bank account, YEA or wire, remain exempt from this tax. Saving advice, come for seniors who regularly support family members living in other countries. This rule is worth knowing. The workaround is straightforward. Use your bank's digital wire transfer service instead of a cash-based storefront, but only if you know the rule exists in the first place. So what does all of this mean practically for a senior trying to navigate their finances wisely in 2026? It comes down to a handful of things that are genuinely worth carrying with you into every significant financial decision. First, when you need to move large amounts of cash, whether it's from a home sale, an inheritance, a matured C, or years of savings, be transparent with your bank. Transparency and communication with your bank about large or frequent transactions can help expedite the process and avoid potential issues, demonstrating good relationship and legitimate activity. My bank tracker banks are not your adversaries. They are required to follow these rules, and when they understand the context of a transaction, the process goes far more smoothly. Second, resist any temptation to break up large deposits in an attempt to stay under the US dollars 0.000 threshold. The law treats that behavior as a crime regardless of whether your money is completely clean, and the consequences, account freezes, asset seizure, federal investigation, are wildly disproportionate to what you were trying to accomplish. The single best thing you can do with a large legitimate sum of cash is deposit it all at once and let the 8-year process run its course quietly in the background. Third, if you are a senior with any kind of side income, from freelancing, from Etsy, from renting a room, from occasional consulting, understand that the reporting thresholds for payment apps and 1,000 at siyam na putsyam have shifted significantly in your favor this year. You are not under the microscope in the way many feared. But that doesn't mean you're invisible either. Keep clean records of where your money comes from and what it's for, not because the government is watching your every move, but because the best protection you'll ever have against any financial scrutiny is documentation. Fourth, and perhaps most importantly for anyone approaching tax season, make sure you or your tax preparer knows about the new US dollars 6,000 senior deduction. It won't find you. You have to find it. Ensure your tax preparer knows about the relevant schedule and double-check your modified adjusted gross income to ensure you're getting the maximum possible shield. Saving advice, come in a year of rising Medicare costs and persistent inflation, this deduction could represent real money back in your pocket, but only if you claim it. The US dollars 0.000 rule has been a fixture of American banking life for over 5 decades, and it isn't going anywhere. It was designed for a different era, targeting a different kind of criminal, but it has aged in a way that now routinely sweeps up ordinary, honest people who simply didn't know it existed. In 2026, with more rules layered on top of it, new reporting thresholds, new excise taxes on international transfers, new senior deductions that require active claiming, the financial landscape for retirees has become more complex than ever. But complexity is not the same as danger. Every single one of these rules has a logic to it, and once you understand that logic, you stop being a person who stumbles into problems and start being a person who moves through the system with confidence. Knowledge is the only thing standing between you and an unnecessary headache, and now you have it.